when you turn over every single stone from a valuation perspective, you get better results. The property that we looked at, the first thing I did was do a Google search on property values. The first thing everyone does is say, jump on CoreLogic. The other sites are Open Agent, Property Value, On the House, property.com.au, view.com.au, real estate and domain. And within all those websites, what you've got there is a bit of an indication in terms of property value. NAB comes back in at 1.14. CBA comes back in at 1.11. And Macquarie Bank comes in just a little bit over $1 million. You could pull out 890 on this property with CBA. We go to 88%, and now we're pulling out 979,000, which is what, 90K? 90K for the same properties.
Yeah.
That's a deposit for your next investment property. So when people say my property value isn't stacking up, we'll go to CBA, get a computer-based valuation, pull it out at close to 90%. To me, as an investor, this is where the game is won and lost in terms of being able to pull out equity to go again. Everyone, welcome back to another episode of the Australian Property Investment Podcast. We are pulling back the hood in true Atelier Wealth fashion. I'm joined by Damien Walker, Nate Condie. You could say the brains in the business, not the beauty. How you doing, lads?
Good. Yeah, good.
I'm doing great. This episode, if you're listening audio, I'm saying probably switch out and jump onto the video. I'll include the link to probably a YouTube video on this. This episode to me is something I've been trying to do for a long time, which is pulling apart valuations. To me, as an investor, this is where the game is won and lost in terms of being able to pull out equity to go again. I'll give you an idea. As an investor, you're usually covering one of three things. The first one, borrowing capacity. The ability to keep buying is ultimately dependent on your borrowing capacity. I could stack 5 properties in front of you, but if you don't have the borrowing capacity to do it, those 5 properties are just going to tease you effectively going, I wish I could. The next part is equity. So this is the part where you pull out equity from an existing property that you have. And that's the part that we're going to be doing a deep dive on today. The third one is cash flow. This is, to me, where current investors are probably feeling a little bit of the pain, particularly where rates are at the moment, and yields, where yields being property and rental income. They're going, I can see the ability I've got to buy 4, 5, 6 investment properties when Nate does the Strategi, for example. But where they're falling down is I can't afford to keep plugging a gap. What do we see, Nate, on some of these properties? The gap on them, like $100, $150 sometimes
A month or
a week.
Yeah, a week. Yeah, a month. We're talking about $1,000.
Some properties, depending on the yield that they're shooting for.
Definitely.
So we're talking maybe circa $200 a week. And you put that over maybe 3 or 4 properties. They're going, hang on, mate, I can't afford to hold these because of negative cash flow. Well, you've got 2 options. One is you go PAYG withholding variation, or you simply don't buy the property. And I say, at the moment, property investing is a game of grip strength. Who can hold on the longest? There's talks this year. I don't know what the truth is about rate cuts coming through. If you can just hold on, you'll be the beneficiary, not only in 1 month, 1 year's time, but maybe over a couple of years as well. And if you can get that property to compound, you can't eat the capital growth, but over time, you will be able to eat that cash flow as well. So I want to lay that as kind of a foundation for today. What we're doing is unpacking valuations, and I've got the boys to have a look at some properties that we've recently looked at. I'm going to give the address away purely due to confidentiality. That's why I say this episode is going to be great for video if you're listening, just so you can get a feel for the numbers that we're walking through, which may not translate well to audio, but hang in there. So the property that we looked at, when I went, the first thing I did was do a Google search on property values. And if you're doing this, when you get given a property by your buyer's agent, for example, the first thing everyone does is say, jump on CoreLogic. The other sites are Open Agent, Property Value, On the House, property.com.au, view.com.au, real estate and domain. And within all those websites, what you've got there is a bit of an indication in terms of property value. Now, this is where it gets interesting. If you jumped on real estate or domain for this particular property that we looked at, the range is anywhere from 810 up until 1.25 mil. Let me just say that range again. 810K up until 1.25 mil. That's insane as an estimated range. Sitting within that is what they call a confidence metric. Low, medium, high. High, for example, would be like, we're getting that in stuff like Perth, right?
Perth.
Like some of those booming markets, for example, Brizzy, you look at those markets where it's high. Low is probably something like, I don't know, Melbourne. Hobart.
Just where there's a unique sort of like, I guess,
spectrum of properties in a suburb. Like it's got like apartments, townhouses, houses.
Yeah.
The algorithm is looking at bedroom and land size, really, right? So that's where we see a low confidence, and could be anything, right?
Yeah. And so you typically see that in markets where it's either hot or low, it's not. And so when I'm talking about suburbs and locations, I'm not disclosing where people are buying. I'm pretty much just saying we see enough of this that when we say refinance your client out of Tassie, it's maybe a softer market, i.e. low confidence in those estimated ranges. And what we'll do is include some of the graphics as well. I'll also maybe put up a cheat sheet around this so you can see what I'm seeing as well. So here's what we've got. Now, when you've got a medium or high confidence, we know that we can generally push that valuation, right? And this is probably something that I talk about a lot. When I started out in mortgage broking, this became like my X factor. When someone came to me with a property and they said their broker thinks it's worth 500, I might give me that. I'll give you a valuation of 580. I'm going to rip the equity and go out again, which is probably why I cut my teeth a lot in the investor space, because I just went and ordered 20 valuations. I remember one client just going, "Mate, my property manager's got like 15 calls. What's going on here?" I was like, "Oh, they weren't meant to go to full valuations," which I'll come to in a second. But what I'm trying to say is when you turn over every single stone from a valuation perspective, you get better results. And this takes time. Mate, this takes you time and the team to do multiple valuations. But that's what being a strategic mortgage broker is all about.
Yeah, that's right. It's like you only need the one val to come back at the right amount and it's a deal, right? Yeah. You can order vals with 10 different banks. Sometimes it doesn't stack up. People might have just bought a property, not quite enough equity there with most banks, but if there's one bank that'll give them the val they need.
Play on.
Yeah.
Play on, right? So, and I hope that we've kind of explained the what we're talking about in terms of valuation. So let me just give you some foundational work here. As a mortgage broker, and we have access to, 30 odd, 40 banks. In a lot of the banks, they give us access to their valuation system. It's an online portal that we go to. We put in our broker credentials. We can then put the address in, and then we can kind of say what we think the property is worth. And then at that point, based on the confidence, based on experience, we generally know, can we stretch that valuation to come back in at the higher end, which will enable us to pull out more equity. And I think that's a bit of an X factor that we have that I've been able to train our team in to go keep pushing, get those valuations higher. So now what we're saying is we've moved away from this conversation being about, hey, try and get the lowest rate. I'm telling people, get more equity out and go and buy more properties, because the low rate becomes irrelevant if you can't scale your portfolio. So I hope you're connecting the dots as you're listening to this, because this is certainly our secret sauce that I'm sharing with everyone. And I want you to take it and run with it. Let me tell you why this becomes important. And Damien, I was saying before, I get fired up. I absolutely get fired up over this. I'm telling you right now, I'm not going to say who it is. There is a huge brokerage in Australia, wins plenty of awards. I know this because I interviewed a team member from there. They don't do upfront valuations. Mate, you're laughing. You're laughing. This is true. This is a true story. They don't do upfront valuations. They only do valuations when they submit that loan to a bank. Crazy.
Yeah.
Dude, I'm about to swear. I don't understand this. It blows us away. As a strategic mortgage broker, you come to me, I'm like, is that all the vals we've done? And you go, yeah, pretty much. Might show me 15 different line items on an Excel spreadsheet. ANZ, CBA, Suncorp, Macquarie, ING, the big four banks, Gateway. Mate, keep going. Who are the other lenders that we do upfront vals with?
AMP, ING, Macquarie. I missed most of who you said, but everyone. Trust me. Yeah, we're doing everyone.
Right? We're doing everyone.
Yeah, and it's like, as a broker, you're just creating more work for yourself, because you go to lodge the application and it comes back in lower. Like, what are you doing?
Yeah.
You know what I mean? Like, or if it comes back, and if you could be getting vals higher with another bank, you're just missing out on the chance to give your client the best outcome.
Right.
Yes, that's it.
Dude, that's what I'm talking about. It's part lazy broking, it's part conservative broking, and it's not pushing the boundary. I don't know, mate. What's your read on it when you hear?
Oh, it's very much lazy broking, and it'll all depend on what the final outcome of the client wants to be. But for all our investors, we're looking to get equity out, right?
So again,
and how the valuations work, you've got different types of valuations. You've got your AVM or computer generated one.
Perfect. I'm glad you said this. Let's explain this a little bit more. So, AVM in plain English.
Automated valuation model.
Yep.
Computer generated, I like to say.
Call it desktop, computer based.
Two different ones there. AVM, I'll jump in. AVM, it definitely just computer based. an algorithm will spit out a valuation, but very similar to the ranges you get in realestate.com or Domain. However, the bank will lend against it.
Yeah.
So bang, really automated. You get them so quickly. A couple of banks do them. How many bank like?
Macquarie and Westpac specifically, name dropping a couple.
Yeah.
CBA, Bank West. More of them are getting to that point now where they're relying on the AVMs. Yeah.
Yeah. So bang, you get 4 or 5 vowels. I did this one for us. It took me about 5 minutes to do all these AVMs. Very quick. Then you've got a desktop vowel. That's where there's someone at a computer looking at the property. So there is a human interaction there.
Yeah.
Takes about 3-4 hours to get it back. So order it in the morning, you'll get them all back in the afternoon. Pretty much right now.
Yeah.
And then you got a full vowel. And that's when they go and inspect the property. And that's where the bank will pick a valuer from their panel, which is generally like 4 or 5 valuers for a suburb, send them out to the property. We get a full report. There's probably another type of vowel in there called a curbside as well.
Drive-by.
A drive-by. And you've got to warn your clients because I've had clients. I'd ordered the vowel, went curbside. Sometimes they upgrade automatically. And they said to me, someone was at the front of their house just peeking into our windows. And we're not like in the lawn, but from the car. And I was like, oh, yeah, that's the valuer.
Yeah.
Good valuation, but in the end, so they were happy. But yeah, they're the types of vowels that we can get right.
So just if we reiterate that, slow down and explain it to you guys. An AVM, instant computer-based valuation. It then moves into a desktop, which is generally a valuer that's working on that as a desktop, and they give us almost another computer-based report.
Desktop computer, essentially. Yeah.
The next one is drive-by.
Yep.
And then the last one is a full valuation. Now, most lenders will do free valuations. The only ones that typically charge you for valuations are non-bank lenders. So your Resimax, your First Max, your Bluestones, your Peppers of the world, sometimes what you call third-tier lenders. So they're generally going to ask you to, as a client, to pay for the valuation. Circa, what are we talking, $300?
Yeah, depends. If they'll charge for AVMs and desktops as well.
There you go.
They're cheaper.
Yeah, it's only 20 to 30.
Yeah, you're looking at about $30 for an AVM, $100-ish for a desktop, and then for a full val, anywhere from $200, $300.
Yeah,
it really depends on the value of the property, right?
Yeah,
once it goes over $1 million, they chuck on an extra couple $100. Yeah.
The rich tax.
Yeah, it's hilarious.
They'll say that it takes more work.
Yeah.
So this is like the dark arts when it comes to valuations.
Correct.
You understand why I get really revved up over clients that come to us going, the last broker said the value was here. I look at it going, mate, we could rip out 100K more equity. And sometimes that's an extreme example, but I'm like, there's always more juice in the tank left to squeeze. And so that's, to me, when we talk about being a strategic mortgage broker, one question I'll be asking of your broker is, show me the valuation results that you got. And I asked for our team to do that quite a lot in the emails, going, just outline all the different valuations in a small table, and you can start to see the varying degrees of valuations. So let me come back to this property that we examined this morning. So we're just going to pull out 3 bank valuations, right? So we've got NAB, CBA, and Macquarie Bank. This is the same property. NAB comes back in at 1.14. CBA comes back in at 1.11. And Macquarie Bank comes in just a little bit over $1 million. So when you're talking about an 80% lend on this, the variance on that, human calculators will be able to do this for me. What do we got here on the 80% LVR?
So we get a variance from the top to the bottom in terms of potential equity you could get of around $43,000.
Cool.
Yep.
So 43.
And I'm at an 80% LVR.
80% lend. Great. So purely because just on turning over a few more stones, you've left $40,000, nearly $50K on the table for a client.
If you went with the lowest vowel.
If you go for the lowest vowel. And let's say, for example, you're buying loans on rates, which you'll hear me time and time again say, you are not buying loans on rates. We're not flinging product here. We're not flinging bread off the shelf and you buy it based on price or unit price. You're buying loans for outcomes. Does it give you extra equity? Does it give you extra borrowing capacity? Far too many brokers are just selling product. They're peddling product and peddling rate. I don't care what the rate is, and you shouldn't care as an investor. I'm not saying be ridiculous and don't go to a third-tier lender all the time, but ask the question, is this going to allow me to pull more equity? Is this going to allow me to borrow more? And that is a litmus test for where a good lender fit should be, okay? Then what you do is, then we go to the next step, which is, okay, hang on, we've got a valuation, but can I go to say 88%, which is, as you listen, you hear is kind of a sweet spot for being able to sit under the 90% loan to value ratio, including mortgage insurance, cop a little bit of LMI. But in this example, and let's go to CBA because their valuations will let us go to sub 90%. And what we're saying is you could pull out 890 on this property with CBA 80%. We go to 88%, and now we're pulling out 979,000, which is what, 90K?
Yeah.
90K for the same property.
Yeah.
That's a deposit for your next investment property sitting right there in that current property that you have. So when people say my property value isn't stacking up, we'll go to CBA, get a computer-based valuation, pull it out at close to 90%. There's a deposit sitting right there. Let's rock on.
Pay the LMI, pay the higher rate.
What's it now? That like 10 grand or something?
Yeah, 1.5%, whatever it is, depending on the value.
That's 10 grand.
Yeah.
And so 10 grand, but I mean, here's the thing. You're spending all that money on a buyer's agent. 10 grand when you do now you might be able to do the numbers on this for me. Let's say you buy a property at 550 and it compounds at, let's say even 5%. So what's that? 20 odd K in the year? Well, put him on the, sorry, mate.
25?
Yeah, 25. Right. And you paid some mortgage insurance. You'll get that back in a few months' time.
Yeah.
Yes, so many times, and that's been conservative on that type of compounding that I'm doing there, just off the top of my head. So when you buy a growth asset and you're talking 10%, 12% in year one, and you paid 1.5% for mortgage insurance, come on, guys. Come on, let's think bigger here. Don't see LMI as the enemy. See it as an enabler to get into the next property. Use it on pulling equity out, for example. Let's go again. I'm not being flippant here around fees. These are fees and it's a pay-to-play model. I absolutely understand that. I hear that. I see where you're at. But if you've got the ambition, you're trying to match that with a loan strategy, be open. That's all I'm saying is be open to these type of ideas, because by shutting yourself off or you're broken or thinking big enough, you could be leaving opportunity on the table. And guys, we see this time and time again, right? Time and time again. So what I really wanted this episode to cover is, one, the philosophy behind valuations. To me, if you can understand the philosophy here, now what I want to do is translate that into the actual policy, because just because you can do something, one doesn't mean you're one able to, or two, you need to. Yeah. And so this is why I want to apply this to policy, because I can dangle the carrot, but if you actually can't get it, it doesn't mean much to you. And what I mean by that is you've then got to qualify with said bank. Okay. So let's say we go to CBA and we've got this incredible valuation, for example, but for whatever reason, you don't qualify with CBA for whatever reason. And you go, right, we've got to change lenders. Now we're choosing valuations based on policy as opposed to the result. Again, this, like, I feel like you play these games of guess who, you strike out. Okay, that doesn't work. Strike out these banks. And that's what I generally had to look at when I first started lending was, okay, which lenders do we strike out straight away? You probably take out, I don't know, a Latrobe, a Liberty. Like you take out these lenders that, one, are very, very expensive and they, we don't need to use them. Then we take out small lenders like a Teachers Mutual Bank or someone else here, strike them out because they're not going to sit in this realm. And then we're left with this suite of lenders. Okay, now we know who to go to from a valuation perspective. Those values didn't stack up. Okay, close those ones down. And then we're left with this little cohort of lenders at the very end going, this is who we think we could start to parlay with as well.
Yep. Yeah. So we're looking at like different types of policy. Yeah. So the valuation is one thing, but then finding the policy to meet it is another. So going to Aaron's point, we're looking to cash out up to 80%. No LMI. Who's going to do it, guys?
Yeah.
Pretty much everyone, right?
Everyone.
Yeah, everyone. And then it comes down to, well, how much are you pulling out in equity? Because this becomes the next part.
And loan size. Yeah.
So the actual equity. So when we will use words that are interchangeable. So we talk about equity release. Sometimes we'll refer to that as a cash out. They mean the same thing.
Or even a top up as well. If it's with the same bank, we'll usually call it a top up.
Yep. So I just want to make sure that we're clear on some of the vernacular that we're using, because it's all interchangeable words that we're kind of playing with. So if we said to you, you got $1 million loan, $1 million property, the loan's $500,000. We've got $300,000 worth of equity that we can pull out
at an 80%
lend. I hope that's kind of explained it very well. Okay, that $300,000 is let's rock on and get that as an equity release. Separate loan split is what we're doing. Now what happens is some banks will go $300,000. We're not just going to give that client, we'll give that client $300K in their bank account willy-nilly.
Yep.
Why? A bank is thinking in terms of risk, $300,000 unsecured to that client. they pose as a risk for some for some banks. Other banks like rock on. And so when we talk about unlimited equity release, unlimited cash out, there's a number of banks that will happily play on in that space as well. So again, I want you to be well versed, educated in this, that when we're having these conversations, and that's pretty much been the whole point of the podcast, which is to raise the frequency of conversations that we're having, educate you as well. Hey, you know the vernacular and what's going on in broker land as well. So
Definitely.
Damien, fill us in.
Yeah, so we're looking at like a lender will have a cap on how much they'll release to you without any evidence. So broker commentary, essentially. Normally, it's just going to be for our investors, future investment property purposes.
Yeah.
We're going to be using this money to fund the deposit, stamp duty, legal costs of BA. And depending on the lender, some will accept that, and it all depends on the loan amount as well. So, for example, some of the bigger lenders will let you get up to $1 million with just broker commentary. So we could effectively get $1 million loan for you, have it in your account ready to use for, a massive acquisition year.
Yeah, so you might use that $1 million. Yeah, again, go on a bit of a buying spree.
Someone buy a whole property outright with that, and it's an unencumbered asset.
Yeah,
if you wanted to.
Well, you take that and split that over like 4 or 5 deposits, for example.
250, so off you go.
Correct.
That's nearly enough for $1 million properties.
There you go. Right. Yeah, you buy properties at say 650, and we're taking those deposits and splitting them, and then we can talk about the next phase of purchasing and structuring those investment properties. How do you go in for 20% deposits? Do you go 15, 12% deposits? This forms part of the discussion. Again, there's no right or wrong here, but it's going, how many properties do you want to buy? How quickly are we acquiring? How much equity do you think those properties are going to have versus equity on tap that you've got here already? Or is it too skinny, or is it too early? Like sometimes we have clients that are settled in 3-6 months, they're trying to come back, strip the equity. It's like, it's still got to do there's still to be some appreciation or capital growth here in order to take the equity out. So sometimes it could be even a patience thing, not us being, I don't know, not
I did it.
a very fan.
On yours? Well, yeah, I tried to.
How did it say?
Well, the equity was actually there.
We had it ready to go. Yeah.
So there's nothing. We're having to do
the worst client. He comes to me. It was before Christmas. Hey mate, we've got to move now. We've got to get equity. I drop everything, do an application for him. 2 weeks later, we're not going to go ahead. Yeah. So that is no. That's.
But yeah, if we go back to this whole equity release policy, understand it. So some banks will go, if the client can service the massive equity release, for example, we'll give it. Other banks will say, over say 150, 200K, for example, they might just put a limit on that, and that would maybe determine, if we go to said bank or we go to a different bank, for example. So again, we sometimes do that filtering in our loan strategies that go out to a client. Sometimes we may be even guilty of not explaining that deep enough. That may be a shortcoming that we have from time to time. But maybe it's just asking the question, have we looked at other banks? Yeah, mate, we're going to Bank West because they will let us pull out equity. And it's, this is black and white policy. I'm not kind of sharing hands. That's under the table. Open source, we're talking about policy here. Macquarie Bank's another great lender for that, for example. AMP is another great lender. CBA is another great lender. So when we're looking at our lender mix and our lender selection, we're looking at not only the valuations, but will they let you actually pull out that large amount of equity too?
Yeah, I'd say, and we've been guilty of it in the past. Like, if your broker isn't presenting multiple banks to you, ask why. Like, ask why there's only one lender option.
Yeah.
And if we're presenting,
awesome reason.
Yeah,
I mean, we've had this.
We've done it. We do it all the time. But we're getting to the point where now we'll tell people why we're presenting only one bank.
Yeah.
So yeah, just make sure. Yeah, I guess to catch them out on if they're being lazy or if they haven't done all the work or they just don't know enough.
Yeah. I mean, that leads us to another point. Here, I'm not trying to fire shots at other brokers, guys, but I've got to tell you some of the stuff that I hear when clients come to me that we haven't worked with, and I hear some of the crap that they've been peddled. I feel like it makes my job a little bit harder that I'm like, come on, man. Like, I've got a mindset around growth and so many other brokers don't. Like, it's not lost on me. The bar is set far too low in our industry.
Yeah, definitely.
I mean, we see it all the time, guys. We see it all the time. Let me talk about lender spread, because here's what happens. How many banks, I'm going to put you on the spot, Nate. How many banks do you reckon we've used in the last 12 months?
Over 20.
Over 20. Yeah. Damien, you've been the same. What that means is, for our client base, we've gone to over 20 different banks in the last 12 months. Do you guys know the industry stat?
Oh, probably 3. Is that right?
Yeah, it's up to 4 to 6.
4 to 6. Yeah.
4 to 6 banks are typical brokers using.
I'm hiring credit analysts at the moment. I'm always like, what policies have you worked with? About 4 to 6 banks. You're right.
Yeah. For
Macquarie,
Macquarie,
First Mac if it's desperate.
Yeah. and then like definitely a non-conforming lender like Latrobe or Blue. So I was like, that's wild to get from the big 4 and then go First Mac and then Latrobe.
Yeah.
There are so many lenders in the middle there.
Lenders, yeah.
Guys, I'm saying this, it's not convenient for us to use 25, 23 different banks in a year's time. There's 23 different sets of policy, 23 sets of ways to submit an app and the back and forth. We spread ourselves a little bit thin, but that's what you do when you're a strategic broker. I'm not saying me. So many of my peers that I talk to that are top 100 brokers and up echelon brokers, they're doing the exact same thing. I'm advocating for using a top tier broker.
Mm-hmm.
That's what, hear me out. I'm advocating for using a good strategic broker. I'd probably look at the top 100 and go, they're probably shooting the lights out, or someone's got some real skin in the game. They've been around for some long time. When I hear about brokers that use an average of 4 to 6 lenders, I'd say go find a new job. Like, honestly, it's harsh. It's true. Most brokers should go back to a bank and get a job there, because you see what they're offering. They'd earn far more money at a bank.
They probably would, yeah.
They'd actually earn far more money in the bank. And I hate to think that they're putting investors' portfolios second to their own convenience.
Mm-hmm.
When I know how much our team busts their chops to go back and turn over every stone. And yeah, we charge a strategy fee, for example. Why wouldn't we? When we put the time and effort in hours, and there's brokers have sat on those deals and worked with those clients for years, and now suddenly the deal's about to walk out the door. Now they suddenly go, yeah, I can find a solution. Well, hang on, you had all those years to work on the client, and now you're trying to get them on the way out. Vote with your feet, man. I can't make that any clearer. If you want the best for your portfolio, vote with your feet. This is not me angling or farming or fishing for business. I'm telling you, there are so many top brokers that I can look in the top 100 that will do you a solid in terms of your portfolio. What do you think?
Yeah, 100%. I think if you've got your existing broker that's umming and ahhing a bit, just ask the simple questions. You know, how many valuations have you ordered for my property? Especially and this is mainly for our investors, right? We're not talking about buying the first home. That's really straightforward. Refinancing to get a lower rate. Of course, we're going to go for the lowest rate.
Yeah.
But for our investors, this is where it gets technical. This is where, I guess, our time on the deal gets so, I guess, elongated with the amount of work that we can do, which is
takes hours. So to do valuations,
doing the vows, looking through policy. You know, I've got a point here where it's like, even if like it's not the valuation that gives us the usable equity. So it's not the valuation, it's the policy and the valuation, right?
Yeah.
So you might get a valuation of $2 million with the bank, but going back to the point of having a cash out policy, you might not be able to get it. They might say, no, we won't give you any cash out. So what's that valuation worth? Nothing.
Yeah, correct.
You know, you might get a valuation a little bit lower, but that bank goes, you can go up to 88%. I'll give you the money for a deposit. Perfect. You need to be able to marry so many different factors, policy, vows, interest rate as well. That's definitely always there. But if your broker's just going, here's the lowest rate, here's a bank I like working with, they're fast. I always hear that. They've got quick turnaround times. Who cares how quick the bank processes a loan?
I mean, we're doing stuff with some banks at 12 business days.
12 business days, they're going to give you an extra 100K.
Yeah.
How good's that?
And I looked at, when I looked at where our lender stack goes, you go policy, rate, speed, and maybe the fourth one could be service. And that becomes super important sometimes from a relationship perspective when we're trying to push things through, or maybe get an exception to a policy, for example, based on the relationships that we've built with some banks. Okay. So when you talk about policy, that becomes the first filter. There's no point selling a product on rate if you don't qualify for it. That's probably the number one golden rule in broking, which is why would you promise the rate when they don't qualify for it? Okay. So you go fit for policy, your loan's fit for purpose with that bank. The second one, becomes rate. Hey mate, if we can go back, save the rate. This even becomes important from a post-settlement perspective. Hey, you might put the client into that product right now, but if we can then say get him in at 88%, revalue the property in 6 or 12 months with that particular bank, now reprice the loan sub 80%. We haven't had to move banks. We can stay where you are as well. So there's no need to kind of churn and move clients necessarily, not even to clip a ticket from a commission perspective, but just go, it can stay where it is, and we can just go back to the bank and say, look, the LVR, so loan to value ratio band, has now changed. Can we review their current rates? Bang. The other point around rates is, And again, I'm not tuning our own horn, but I'm just telling you what we do from a client perspective. We go back in. Some banks will let us review rates on a 6-month basis, some a 12-month basis, and we have team members specifically sitting in roles to review every single client's loan. Yeah. We are recruiting for a post-settlement person. I've got to tell you, we can't recruit anyone in the industry because that role doesn't exist. Very few brokerages actually have someone that sit in a post-settlement role, which is someone managing their entire client's portfolio. So, and I think when we've done this, since we've done it for the last few years, $2.5 million annually goes back into our clients' back pockets. That's come from interest from a bank. The banks would earn that interest from our clients. We've put that back into their back pocket. That's not measured over 30 years. That's measured over 1 year in terms of annual savings. So again, I want to show you when we talk about strategic brokers, it's not only on the front end, it matters on the back end as well. Okay. And then, so we've got policy, rate, speed. To your point, Damien, nailed it. What's the point in getting 2 business days if you can't pull out more equity? So speed really only matters to me when you're trying to either make an offer, unconditional, move super, super quick, or it's a tight turnaround time, or whatever reasons. Speed helps, I guess, from a client experience perspective. Hey, mate, that went through smoothly. We look like superstars. That's why everyone loves Macquarie Bank in the industry, because I'll do it in 2 to 3 business days and we look like rock stars. Yeah. But Macquarie Bank are fantastic for some things. Other things they know they're not great at. They don't play in that space. Yeah. So then we're looking at fit for purpose. So speed, to your point, becomes 3rd or 4th importance. And then the last one becomes a great client experience. So some banks onboard their clients very well. Some banks it's a little clunky. And I think that throws a lot of borrowers or clients out going, I thought they do this daily. I'm like, yeah, we do it daily. We mess up, but this on a giant scale, and with all the tech that you have these days, there's still things that are archaic, slow. I mean, one top tier client. Let me talk about this one. Top tier client overdrew one of his accounts, very small. Oh, how much was that?
$10.
$10.
Really? No, it was the 2 annual fees, 2 monthly annual fees, $16. Yeah,
$16. And they wanted a letter to make sure this type of account conduct didn't happen in the future. Now I said to him, mate, look, this is the silly stuff that we get, but it's a ticking box exercise. But that's why I feel we exist sometimes. There's a bit of common sense filtering approach to go, hey, man, the bank's asking for this. Just sign the letter that it won't happen again, and away we go. And mission accomplished. So I'm saying from a customer experience perspective, we can't, and I think that's what they always say, like brokers go, oh, you're great experience, come to in speed and fast and easy. Mate, we cannot guarantee an easy experience.
No.
We cannot. You get an assessor inside the bank, you put the same deal in front of 2 assessors and you got 2 different outcomes. We can't guarantee an outcome sometimes. Going, the assessor's own prejudices come into it, the assessor's own experience or their own interpretation of their policy weighs into it. That's out of our control. It's out of your control, for example. All we can do is do the dance with them and get the outcome they're all shooting for as well.
Which is going to that, it means we need to be prepared. And especially for our investors. You're up to your 4th property, your 5th property, when they're doing a trust potentially, when maybe extracting equity in the LMI space, multiple lenders, staged applications, all that jazz. It doesn't happen overnight. It happens very slowly, and you might be keen to go and buy, but get pre-approved and make sure you've got that letter. Otherwise, what's the point of putting an offer on a property? If you've got a contract to sell with your name on it, you're going to have to pull out of it. Your buyer agent's going to be pissed off.
Yeah.
Broker's going to be
you're frustrated.
You're going to be frustrated. What's the point?
We say, however long you think this experience is going to take
another
double it. Double it. And that's an disclaimer.
And we don't want it to be that way.
Yeah.
We get paid per deal. We get paid at settlement. Like nearly everybody in the transaction, conveyancer, DA,
real estate
agent, everyone gets paid at the end. So if you get to the end as fast as you can, you're going to get paid more.
Speed. Yeah.
Per hour, more.
We can't rush it if we're not organized. Like, let me walk, I think I might walk through the client experience. Like, we need to do the initial call. Then we need to get documents. Then Nate and Lauren and Damien and the team need to do the loan strategy, present that back, choose a lender. That's with, multiple back and forth about how we got there, why have we got there, where have we thought about this has changed, for example. Choose a lender. It takes us a couple of days to even do data entry and produce compliance forms. It's nuts in 2025. Get that back out to a client. Adobe signed. Double check they've got all the right documents. Has anything gone out of date? Submit it to a bank. It sits in a bank queue for 2 to 3 business days before someone picks it up. They come back, ask a few questions and back and forth. I hope that you can start to see this is just get pre-approval, man. Like we can be talking weeks here.
It's not in our interest to drag the process out.
Not at all. We don't.
We want it done quicker than probably later,
Yeah.
right? We want it,
And that's that whole enabler mindset that we're like, hey, man, we're here to enable it. Help us help you. Let's get organized. If you're thinking about buying in 2025, and let me tell you, I literally had a chat with our team earlier. This is the year to be buying, 100%. It talks about rate cuts, for example. If you want to really put that whole Warren Buffett mantra to the test, be fearful when others are greedy and be greedy when others are fearful. There are people that are talking about recession and peddling all the stuff that they're seeing on news as like gospel for the property market. Have a look at Black Friday, have a look at the GFC, have a look at COVID and what happened to the property market afterwards. Dead cat bounce, it falls down and it goes to new highs from what it was previously to that event. I'm telling you, if you're going to sit there and subscribe to the 18-year property cycle, we're in doom and gloom and the world's going to fall in our heads and a recession's coming. I'm happy for you to sit out the market and let other people scoot ahead and then you wonder why you're left far behind. I've got to be very clear. If you're listening to this, one, you're an action taker. 2, you need help making decisions. I'm telling you, we're here to help you. We want to see more investors win. You win, we win. That's what we tell our clients. Your success becomes our success, not the other way around. So we win awards. It doesn't matter for clients, right? We get more views on the podcast. That doesn't matter. When clients win, we win. And that's what we're generally championing, going, hey, mate, if you do well, we're going to ride the coattails off that as well. But the more people win, the pie gets bigger. Mate, on our watch, we want to see investors kind of shoot the lights out. So on that point, a couple of things that you probably know that's going on behind the scenes. Our Property Accelerator group is going great guns. Group 1's full. We're taking names and details for group number 2 to kick off. What we're doing there is it's a good hour. It's once a month. Yes, the second group now is pay to play because we want people to have skin in the game. So it's a very, very small fee. But what we're doing now is getting a cohort of investors that want to be in a community together, that want to see each other win, that want to be held to account in their own portfolio and their own actions. If that's you, drop us a message, say Property Accelerator. We'll reach out, send you the details for group 2 when that's about to kick off as well. We want 50 people in that group to launch that as well. So if you're ready, you want to take action, we want to hear from you. Okay. If you've got any more questions about what we've spoken about around valuations, again, drop us a DM. We're here to help. And I genuinely want to see more investors win in 2025 as we're talking about, I guess, policy. We're going to be doing a few more policy episodes as well. So if there's something specifically you want answered, shoot through the question, man. That's exactly what we want to hear from people, at least with burning questions. That's a wrap for another episode of the Australian Property Investment Podcast. Thanks very much, fellas. Appreciate it.
Thanks.